Throughout this course, we're going to discuss the importance of framing an investment philosophy and using that as the basis for managing a portfolio. Therefore, the first learning objective this week is to define what we mean by an investment philosophy and explain why is it important. So to understand what an investment philosophy is and why it's important, it's first important to take a step back and understand what portfolio management is all about. Portfolio management can be defined as the application of investment principles and philosophies in order to manage the wealth of individuals. Now, the goal of individuals when they participate in financial markets is to maximize their utility. Their utility is their overall happiness, which is a measure of their ability to consume goods and services in the future. So the way we maximize utility is by looking at risk and return. Investors like to maximize their return and minimize their risk. And the process of portfolio management does this through two steps. Those two steps are security selection and asset allocation. Now, security selection is the process of picking particular securities within an asset class. For example, within the equities asset class, it might be the decision of choosing between what proportion of your portfolio you're going to invest in BHP shares and what proportion of your portfolio you're going to invest in Commonwealth Bank shares. Asset allocation is determining of your total wealth what proportion you're going to invest in each asset class. Now, as we'll see throughout this course, there are a number of different approaches to portfolio management that can manage this question of risk versus return, and all these different processes apply different specifications of the security selection and asset allocation decisions. So the process of portfolio management looks like the diagram that we have on the screen here. We start with the client, and we look at the client could be ourselves, or the client could be someone whose wealth we are managing. And we look at their own personal characteristics, and we use that to make both the asset allocation and the security selection decisions. So as discussed earlier, asset allocation is determining of the total wealth, what proportion to put in each asset class. For example, how much of our wealth do we invest in property, stocks, bonds, cash, and so forth. Once we've determined the allocation to each asset class, we then need to decide how we're going to allocate our wealth within those asset classes. That's the security selection decision. So for example, which stocks or which bonds, etc. do we buy? Then comes the process of execution. So we need to understand how we actually trade and what are some of the costs associated with trading. And finally, at the end of the process, we want to see how we performed. So we need to be able to evaluate our portfolio performance. And often the process that we see on the screen here is circular, as we evaluate and then we rethink through our approach to investing and use that to determine what we're going to do in the future. Now, while this diagram we have on the screen here is the mechanics of how portfolio management takes place, what we need is some form of guidance or some form of framework that will actually dictate what we as an investor are going to do at each of these stages. That guideline is our investment philosophy. So an investment philosophy is a coherent way of thinking about financial markets and how they work, and how you might try to exploit financial markets in terms of maximizing your own future wealth. So you can think of an investment philosophy as the plans that an investor has that determines the management of their portfolio. A couple of things to note here. Investment philosophy is a very broad way of thinking about markets. It is not an investment strategy. An investment strategy are the specific processes that you're going to take in order to execute that philosophy. Hence, because the investment philosophy is much broader, you can think of it as a core set of beliefs that's used in order to generate a future investment strategy. So how do you come up with an investment philosophy? Well, first of all, what we need is the tools of the trade. And by the tools of the trade, I mean we need to understand some of the basic principles of finance. You need to understand how risk and return works and how you can calculate them. Often investors will require understanding of financial statements and also be aware of some of the frictions and trading costs that might be incurred. Step 2 then is quite important, because your investment philosophy will depend upon your view of how markets work and whether or not they break down. And in particular, a really important philosophical argument that we butt up against here is the question of market efficiency. So an investor needs to form their own views and beliefs on how efficient they think markets are. If you were of the belief that markets were perfectly efficient, then it makes sense for you to diversify as widely as possible and seek to minimize transaction costs. If you thought that maybe markets are less than perfectly efficient, then you might frame an investment philosophy that seeks to exploit that inefficiency. But rather than just the general motherhood statement of arguing that markets are less than efficient, an investment philosophy needs to identify exactly where you believe markets will break down, and the investment strategy will then identify how you're going to exploit that market failure. Now, through this process of developing an investment philosophy, it is very important that an investor considers their own personal characteristics. There is not a one-size-fits-all investment philosophy that suits all investors. You need to think of things like your risk aversion, your time horizon, and your tax status. Now, there's a range of different investment philosophies that an investor could adopt. Those investment philosophies could include things like whether you take an active versus passive approach. You could have investment philosophies like momentum or contrarian investing, value and growth investing, fundamental and macro investing, or you could invest based on geography. Throughout this course, we'll be exploring many of these different investment philosophies and identifying how they can actually be executed as a trading strategy. But let's give a really simple example of an investment philosophy in practice. Let's say that you as an investor are of the belief that markets are less than perfectly efficient due to investors underreacting to news. So news comes out and investors take a while to adapt that news into market prices. Therefore, your philosophy might be that stocks that have had good news announcements, for example, positive earnings announcements, might be underpriced. They're underpriced because that positive news is not immediately filtered into the price. There is a slow process by which that information is diffused, resulting in the underpricing. Whereas bad stocks that have recently had bad news announcements, they might be overpriced because that bad news has not been fully embedded. Hence, the decrease in the value of that stock is not currently reflected in the prices. So that would be your investment philosophy. So what would your strategy be? Strategy would be the more specific way of executing that philosophy. You might say, I'm going to buy stocks with a positive abnormal return announcement. So for example, those stocks that have positive earnings announcements, whereas you might sell stocks that have had negative abnormal return announcements, those that have surprised the market in the negative direction in terms of their earnings. And we see investment philosophies such as this simple one in practice across a lot of different real-world funds. So here's a couple of different examples that you can look at yourself, but we'll look at this one very quickly. Wingate Asset Management. This is from their own website. What do they seek to do? They're looking at the idea that they think established products, track records, are going to be quite valuable. They're going to avoid paying for blue sky, so avoid paying for growth that maybe is not tangible. And they're going to also identify risk and use valuation approaches in order to identify the reasonableness of an investor. This is an investment philosophy that's typical of a value investor. And in a few weeks, we'll look at value investors. Some other examples. Here's another example, Acorn Capital. Acorn Capital, they're very clearly of the belief in this philosophy that small stocks or micro caps are where inefficiencies might lie, and they seek to exploit that by undertaking fundamental analysis to buy small stocks. They're a small cap investor. And last of all, Sirius Asset Management. We can see from their investment philosophy, this is an investment philosophy based on geography. They believe that there may be mispricings in Asia, potentially due to less transparent information and regulatory issues within some of these markets. So they're going to seek to exploit those inefficiencies by using fundamental analysis. So they're an Asian-focused investor. So now that we've seen the basis of what an investment philosophy is, it's a guiding set of principles or beliefs that dictate how you're going to go about forming your investment strategy. The next question is, well, why might you need an investment philosophy? Why is an investment philosophy important? Well, first of all, if you don't have an investment philosophy, you might become rudderless. You'll lack a core set of beliefs Hence, you become easy prey for anyone selling the latest innovation in financial markets, and more particularly, if you lack an investment philosophy, you are more susceptible to behavioural biases. Second of all, if you don't have an investment philosophy, often you'll find yourself regularly switching from strategy to strategy because you don't have a clear view of what you're seeking to achieve. Now, what we know is that when investors do switch frequently, they incur higher transaction costs and also higher tax liabilities. Finally, if you don't have an investment philosophy, you might actually find yourself investing in some strategy that does not meet your personal characteristics, objectives, or needs. We saw earlier that one of the key components of determining an investment philosophy is to think about your own preferences. Hence, it goes without saying that not having an investment philosophy means you're really not incorporating your preferences into the investment decision-making process. So that's the first learning objective for this week. We've seen what an investment philosophy is, and we've identified why they're important.